let's talk about what is happening in Silicon Valley right now. After the failures we've seen over the last few weeks, Bill, is the sense they're anti-banker? Is it us and them now? Is that the feeling that you get?
No, and I would let you know that the past few weeks have nothing to do with this event that we had yesterday. So, Silicon Valley's been unhappy with the way the IPO works for a couple of decades now. I dug up, some conversations Piero Midiard had at eBay calling it undemocratic. Hambrick and Quist, Bill Hambrick, 20 years ago called the IPO an insider's game. And all the work around the Dutch auction, Google, Larry and Sergey felt that it was unfair in the way it was structured. And so this is really a 20-year effort that's been going on in Silicon Valley and a 20-year issue. It's not something that has anything to do with the past few weeks.
Okay, but nevertheless, let's talk about the last few weeks, because that has kind of focused a lot of people's attention on which routes some of these companies are ultimately going to take to market. Isn't the problem of the last few weeks that actually some of these companies that have been coming to market have been pitched as tech companies, they don't have the gross margins to support it, and as a result of which the public markets have not taken them well?
Well, it turns out, actually, that if you look at even the past year, so just 2019, if you look at the first day pop, net of the losses of the companies that have broken issue, Uber, Lyft, and Peloton, it's $6 billion to the positive, $6 billion in first day wealth transfer net gains. So I guess I just disagree with the notion.
All right. Well, Bill, I mean, look, I know that you've been sort of, banging the drum with regards to, direct listings or really just the whole IPO process for quite some time. When you look at sort of the age of which some of the companies that have come to market is that sort of a side effect, or is that sort of a result of some of the concerns and some of the reticence about doing IPOs? Is that more a reflection of the general idea that it has actually become easier to invest in the private market and extract your profits in the private market?
Well, I think there's two things. So one, it's obviously a direct result of there being enormous amounts of capital in the private market. So there, Stacey Cunningham from the NYSE was at our event yesterday, and she noted that, it used to be, if you go back in time, one of the reasons to go public was to raise capital. And now there's so much capital available in the private markets that you don't have that as a reason to go public. And so I certainly think that's been part of the delay. If you view the process as unfair, that might also be something that slows down your path to get there. But I don't think it's healthy for companies to stay private forever. I think it's super advantageous to companies to pass through and become public. And I'm hopeful that if we can fix this process, that it will actually lead to more companies coming out. Stacey mentioned that yesterday, actually. Yeah,
and well, going public, though, also, Bill, does come with a lot of responsibility. And one of the criticisms that Wall Street and a lot of secondary market investors have had is that with these sort of dual and multiple share structures out there, with the way that I guess the control that certain CEOs and founders have over the companies once they become public isn't really fair. We saw this criticism with Uber. We continue to hear it with Facebook. We see this with so many of the companies that you have had a hand in. And I'm wondering, why do the companies think that they can maintain that level of control and at the same time still take the public's money?
Yeah, to correct one thing, just because I was deeply involved, before Uber went public, we transitioned the entire share base to one share, one vote. So it's actually an outlier in that case. Relative, it has a cleaner governance than most of these other companies. So look, the balance of power in Silicon Valley has been leaning to the founder for a very long time. And so there's tons of sources of capital, and there's only one, Zoom or one Facebook. And that's led to founders being able to make a lot of decisions that they want to make. And in certain cases, that goes to a level where it actually costs the company rather than helping the company. And one of the reasons I encourage companies going public is because I think it ups their game. I think it presents more pressure. It forces them to be more disclosive, more transparent. And for those that respond to that, it takes the company to new heights and to new levels. Even Zuckerberg was quoted as saying he waited 2 years too late to go public. public, and that the minute they were public and the stock fell from 38 to 18, he realized he had a mobile problem because all the investors were screaming it from the top of their lungs, and they responded super quickly. And so I actually think it can be very advantageous against those problems. Unfortunately, and this is a kind of esoteric branch that we might not have time to walk down, there are certain systems that are in place from a regulatory standpoint that make it easier for a company to operate with super voting than without. And it might be valuable to spend time with the regulators understanding that so that you don't have a perverse incentive to put those in place.
Bill, Benchmark's an investor in WeWork. I have to ask what you think the future of that business is right now. And do you think SoftBank's done some damage to Silicon Valley and its perception of what value really is?
Yeah, so I'm not directly involved in WeWork. It's a different one of my partners, and I've quite frankly been spending the past 6 weeks burning the candle late on this conference we did yesterday. I do know that both Sebastian Guggenheim and Artie Minson have wonderful reputations that go way back in their career. And when I look at the actions they're taking that are very swift and deliberate, that I'm super excited that they're willing to do that hard work and hopefully get the company in a better place. On the SoftBank issue, I've been quoted publicly like they've played a strategy where you hand hundreds of millions of dollars to a company and say, here, go win in the market with this. And the only way to deploy that amount of capital is to take on massive losses. There's no way to, these companies don't have massive infrastructure, right. So there's no way to go build factories. They just hire more right. people and attack. And so, I do think it creates a lot of risk.